This strategy is not for everyone, but for the right person in the right situation, it can be a temporary, powerful tool. Essentially, what we're doing is we are switching the mortgage monthly payment from a principal and interest payment to an interest-only payment. And we are using this as a temporary, short-term solution until the person is able to get back on their feet and can afford to go back into a principal and interest payment, which is a higher payment per month. This can look like two different scenarios. The first scenario involves switching from a B lender or an alternative lender mortgage to a private mortgage at a comparable rate. And essentially, we're switching again from a principal and interest payment with the B lender to an interest-only payment with the private lender. And we're taking a private loan here for 12 to 24 months until the person is able to stand back up on their feet and weather the storm, and then go back to either an A lender or a B lender with a principal and interest mortgage payment. The second scenario, which is where this strategy is most powerful, is to switch your payment from a principal and interest payment with a bank over to an interest-only payment also with a bank by converting the bulk of your mortgage over to a secured line of credit. Let's look at a real-world example. Let's say that you have a property that is valued at $625,000 and you've got a bank mortgage for $500,000 at a 30-year amortization at an interest rate of 5.25, and the monthly payment is $2,744. The strategy here is to restructure this mortgage amount of $500,000 into two components. We are going to split it into a line of credit and a very small mortgage. With many banks, there is a product available to you called an Advancable mortgage product. That product allows you to slice and dice your mortgage. And it also comes with a secured line of credit. And as you make principal payments towards the mortgage, that line of credit increases over time. So an Advancable mortgage product comes in with a lot of flexibility and long-term benefits. And that's the product we're talking about here. The idea here is to take the $500,000 mortgage and slice it into an interest-only payment under that product by switching the bulk of it to a line of credit, and then whatever is left over, we can keep it as a mortgage. Here in Canada, the line of credit cannot exceed more than 65% of the property value. So if you were to take a mortgage and split it into two components, the maximum line of credit you're going to be able to get is 65% of the value, and the remaining amount, which is 15%, will have to stay in a mortgage, because on a refinance, the maximum loan you can get here in Canada is 80%, and that is how it would be split under an Advancable mortgage product. So let's look at how these numbers will play out and how they will impact your monthly payment. We're going to split the $500,000 into two components: a line of credit for 65% of the value, and the remaining amount remains in a mortgage at 15% of the value. So we're looking at a line of credit of roughly $406,000, and we're looking at a mortgage of roughly $93,000. Line of credits are generally priced at prime plus half. And at the time of this recording, the prime rate in Canada is at 4.95. There are lenders that will offer you cheaper line of credits at prime or even prime minus, and you should always negotiate a better term on the line of credit. So let's take a look at what our new payments look like relative to our original payment when we had a $500,000 mortgage. Our new interest-only payment on the line of credit is now $1,845. And on a $93,000 mortgage, assuming that we are at a 5.25 interest rate at a 30-year amortization, we are now looking at a monthly payment of $514 per month. Note, we have not changed the interest rate relative to the original mortgage. Our original mortgage was also at 5.25, but this doesn't mean that you cannot switch to a lower interest rate mortgage. So now we're looking at a combined new payment of $2,359 per month. Our original payment on the entire $500,000 was $2,744. So now the difference between these two payments is the extra cash flow in your pocket. And that is $385 difference. And here's the Streetwise advantage of switching to an advanceable mortgage with a secured line of credit. Number one, you now have the option, not the obligation, to pay down the principal on the loan. You're making an interest payment here, you're making a principal and interest payment over there, but here, when your cash flow stabilizes and you're able to make an extra payment, you can. That's number one. Number two, you can switch a portion or all of this line of credit back into a variable or a fixed rate mortgage at no cost to you whenever you are ready. And then the third benefit is as you pay down the principal on the mortgage, the line of credit limit increases over time as long as it doesn't exceed 65% of the value. So you get that bonus as part of being part of this product as well. So it's a product that helps you come out on the other side, gives you payment flexibility, and also allows you to pay down this mortgage when you're ready. And here's the Streetwise advantage of using an advanceable mortgage product with a secured line of credit. Number one, you now have the option, not the obligation, to make a principal payment on the loan. Number two, whenever your cash flow stabilizes and you are in a better financial position, you can aggressively pay down this loan, but you can re-access back the cash you've put towards the line of credit when you need it. And then thirdly, you can convert the entire line of credit or a portion of the line of credit back into a mortgage and resume doing structured principal and interest payments when you're ready. You can switch to a variable or a fixed, or you can create even components with the line of credit with some on a variable rate and some on a fixed rate at no extra cost to you. So this gives you a lot of control and incredible flexibility.